Hi there, welcome to Neppy Invest and welcome to a journal article reaction video. I was doing some research on a question from one of you, I think it was just Jim Cramer, who asked me about momentum trading, and I was just digging, doing a little bit of research, and I came across this particular article released in 1993 in the Journal of Finance, titled Returns to Buying Winners and Selling Losers, Implications for Stock Market Efficiency. I don't care about that last bit. So it's a fairly long article. It's peer-reviewed, 28 pages long. And I was really interested in this because the title, Returns to Buying Winners and Selling Losers. Hey, it's something I said, buy or maintain your winners, keep your winners and sell your losers. So I was interested in that. But what I was really interested is this is related in a way to a little bit of research I did quite a few years ago. Now, I'll just discuss my research I did a few years ago. This would have been maybe 3 years ago, I think, maybe even longer than that. So what I did is I just wanted to see how powerful profit upgrades, profit downgrades, and earning releases can be, and how long that power may be maintained, I suppose. So what I was looking at is if a company releases a really strong announcement, do you see positive reaction for the market over an extended period of time? And on the flip side, if a company releases something quite negative, do you see the complete opposite? And what I found was there was a definite signal. When a company releases something really strong, really powerful, like a profit upgrade, or they beat expectations when they release results, you more than likely will see that share price of that company beat the overall market for an extended period of time. And we're talking about 6 to 9 months. But after about 6 to 9 months, we see that signal becoming lower and lower unless the company releases another strong, powerful announcement. That is why profit upgrades that comes in 3s or 4s, or a company consistently beating expectations, that's why the share price of that company can go on a pretty significant long-term run. And on the flip side, when a company releases something quite negative, more than likely that company will significantly underperform the market for about 6 to 9 months. Now, I'm not sure exactly the time length there, but definitely within the first 6 months, after the company releases that powerful announcement, you're going to, if this was your strategy, you will beat the market. And if you go short on those companies that release negative announcements, you will, again, beat the market. So this was sort of interesting article when it came to momentum trading, because it seems like this article has been used by momentum trading aficionados or experts, maybe not experts, but those who believe in this particular strategy. But what I found really interesting about this particular article, it sort of does back up my own little bit of research. Now, my research was not peer-reviewed. It was something I just did. I don't think it was, I could never actually ever get it peer-reviewed because it was just done on spreadsheets. There was no statistics done at all. So I don't think I could ever do that. But I'd love to see some more up-to-date research on this particular document, or this particular subject, not document. Anyway, I'll go through, I won't go through the whole article. Now, this was written by Narasimhan Jagadish and Sheridan Titman, released in the Journal of Finance, March 1993. So this is quite old. And the data they were looking at was between 1965 and 1989. So you might be saying and arguing, well, this is out of date now, but yeah, maybe not, maybe not. What I found really interesting was, if you have a look at the abstract, I won't go through the whole thing because the abstract's quite long, but at the end they do mention a similar pattern of returns around the earnings announcement of past winners and losers is also documented. That was the thing I was really interested in, because they looked at earnings announcements and how companies performed on the back of earnings announcements, and just wanted to see how long the momentum can continue for those companies who release positive or negative earnings. So that was really interesting. I was really interested to see what their conclusion or what their results showed in that sense. Now, I try to go through the article, but it's fairly boring, and you can just see why, unless you love statistics. A lot of statistics here, a lot of equations. And as soon as I see equations and statistics, no matter what sort of topic it is, I'm going to lose interest fairly quickly. So all I wanted to see was their conclusion, and the conclusion is quite stunning. This was a sort of section I was more interested in, stock returns around earnings announcement dates. So let's have a look at their conclusion, if I can find it. It's right at the end because it's a conclusion. Yeah, we knew that. Okay, so let's have a look for it. There it is. Yeah, so we're talking about a period between 1965 and 1989. And this was really sort of a justification of momentum trading, because what they found is that the strategy, which selects stocks based on their past 6 months return and holds them for 6 months, realizes a compounded excess return of 12% per year on average. So we are talking about a significant beat to the market if you do apply momentum investing or momentum trading. Okay, now we'll go to the end bit here. The return of stocks in the winners and losers portfolio around the earnings announcements in the 36 months following the formation period was also examined, and a similar pattern was found. You are going to beat the market. That's what they're saying. Specifically, stocks in the winners portfolio realized significantly higher returns than the stocks in the losers portfolio around the quarterly earnings announcements. So I'm more interested in, well, I'm interested in quarterlies, but also interested in half yearlies and yearlies that are made in the first few months following the formation date. However, the announcement date returns in the 8 to 20 months following the formation dates are significantly higher for the stocks in the losers portfolio. So that positive momentum for companies releasing good results continues for, maybe 6 to 9 months. They're saying 8 to 20 months. Okay. And they've got some other stuff here as well. Okay, so what I did is also I just asked ChatGPT to summarize this particular article. All I did was a link, and then it gave me some key summary and key findings. In fact, the first bullet point here is momentum strategy. The paper documents the momentum-based strategy, trading strategies, buying stocks that have performed recently and selling those have underperformed, yield significant positive returns over holding periods of 3 to 12 months. So that is your time frame. The other thing they mention here, earnings momentum. The authors also observed similar return patterns around earnings announcements for past winners and losers, reinforcing the momentum effect. So the way I look at this is if a company is in an uptrend and they release positive, or very nearly in an uptrend, and they release positive announcements, that momentum will keep on going. What I tend to look for is companies that aren't in a positive momentum upswing or whatever, and when they release a positive announcement and then the share price breaks out, that's the start of at least a short to medium term upswing in the share price. That is actually what I'm looking for. So it's a little bit different than what they're looking at here. What they're looking at is for those companies that are already in a forward momentum or in an uptrend, that sort of thing. Okay. And they also mentioned impact and subsequent research. Over the past 3 decades, this paper has become seminal in financial economics. Foundation for Modern Research, it launched widespread exploration into momentum investing. Many studies have tested or extended its findings across markets and timeframes. Evidence shows that the momentum effect persisted in the 1990s and beyond, with strategies often earning about 1% per month. I'm assuming that's above the average. They also talk about behavioral and risk versus risk-based explanations. My explanation for why momentum trading would work would be a lot of psychology, but also financial. Yeah, so the whole reason why share prices go up or down is because in the short term, it's more sentiment, more psychology, but in the longer term, it's around financials. And if a company is releasing really positive financial news, that really explains why the share price of a company can go on a fairly long run. Also, seasonal patterns, notably, momentum profits are negative in January, called the January effect, though generally positive in other months. And then ask me some questions, whether I want to continue this research. Anyway, so that's my look at this particular journal article. And it really reinforces some of the stuff I'll research I have done. That when you are looking for positive announcements, that there is a good chance that those companies, if they weren't already in an uptrend, might go into an uptrend. Or if you look for companies that whose trend is starting to change even before they release announcements, that could be a good indication, maybe not an absolute indication, that the run could continue. And if they do release positive news, good results, or a profit upgrade, that could really help in the momentum of the share price moving up. Okay, so if you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.